Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, December 7th, 2020, and I'm pre-recording this Trading Places Live for Tuesday, December 8th. Futures for Tuesday at this point are down just a bit. Taking a look at today's agenda, we'll get through the daily market recap as we always do to start the show. Then I'm going to go into talking technically. I got a few charts I want to show you. Start off with the Dow Jones and show you a couple of other charts, reasons why I think we're going to see a pretty strong Dow Jones in 2021. I'm going to do a new segment behind the charts. So tell you a little bit about why I don't like a certain area, and then I'll explain a little bit going into certain charts. Then we'll get into the earnings spotlight, and then we'll wrap up the show with the three you must see. Before I get into any of that, do want to just point you over to earningsbeats.com. We do have a free Earnings Beats Digest newsletter that's published Mondays, Wednesdays, and Fridays. All you need to do is type in your name, email address there, hit the subscribe button. We'll make sure we get that out to you. No credit card required. You can unsubscribe at any time. Just generally, it's an educational webinar, or excuse me, educational newsletter where I try to focus on earnings related topics, relative strength, and so forth. If you want to be a member to our service, you can hit that green Join Today button. You can take a look at some of our portfolios. I will point out that we are getting very close to tripling our original investment in the model portfolio from November 19th of 2018. So it's up almost 200% now in just a little over 2 years. So it's been pretty strong. Having another strong quarter, up over 11% versus the S&P 500, 3%. All right, let's move on to the action from Monday. Got the Dow Jones Industrial Average down 148 points. S&P 500 was down 7, NASDAQ up 55. Mid caps and small caps both down, showing a little bit of relative weakness. We haven't seen much of that lately. These two groups have been leading the market, but they were down on Monday. So looking at the major indices, the only one really to finish in positive territory was the NASDAQ, which had been underperforming of late. So that was good news for those NASDAQ bulls. The communication services sector was the top performing sector, gaining about 2/3% on Monday. Utilities also strong. I was looking for utilities to bounce right here around the $62 level. That was a recent low. We did have a negative divergence in play on the last high that we saw. And so I was looking for maybe a 50-day test, centerline test. We've gotten that. Wouldn't be surprised to see utilities perform better in the days ahead, although I don't expect it to be a leading sector. Energy weak on Monday, but this is a group that's been incredibly strong here over the past 5 or 6 weeks, especially since the positive vaccine news came out. So we are trending higher above the 20, which is above the 50. PPO looks strong, but we saw a little bit of profit taking on Monday. I think we're okay as long as we continue to hold over about $36.5, $37. Automobiles, top performing industry group on Monday. Tesla, another really big day for that automaker. And Tesla has been one of the best performing stocks over the past year, maybe last couple of years, but especially since it broke above $400 pre-split. It broke above $400. That was back in December of 2019, I believe. So we're talking about just about a year ago. And the stock is now, I think, up around 640, and that's after a 5-for-1 split. So that 400 was really split adjusted about $80. So it's gone from 80 to about 640. Pretty strong move for sure over the last year there. But Tesla again leading the autos higher on Monday. Marine transportation, which has been very strong, basically off the double bottom at the end of October and through the vaccine news, the positive news in November. You can see that the marine transportation group's been very strong, but it did see some profit taking on Monday, down about 3.6%. Moving on to the 10-year Treasury yield, I will say on Tuesday, we've got one economic report of significance. Q3 productivity report, second estimate, will be out. The expectation is for a 4.9% annual rate increase, and that matches the initial estimate. So don't think we're looking for any major revelations there in terms of the economic outlook. 10-year Treasury yield, I think, continues to remain in this channel. We've been seeing this channel now for the last 4 months or so. But we are trading above that rising 20-day, which is above the rising 50-day. I've pointed here to this gap support level. This was November 9th. This was when the vaccine news, first vaccine news from Pfizer came out. And so we gapped up. A lot of folks jumped out of the defensive treasuries at that moment. And when we went back down, check out how we held that gap support level before turning back up. Now we're up challenging the high. I think we're sideways consolidating. And you can see now that this gap support intersects with this trend line support. And the slope that I'm using here is the same slope that connects these highs. So we have multiple highs here and drag that line down, and that now intersects with about that 0.82% level. So I think as long as the 10-year Treasury yield remains above this 0.82 area, then I would continue to treat this as though we are trending higher, which will likely help certain areas of the market, like banks, investment services, asset managers, life insurance. Some of those areas within the financials should benefit. And a lot of times too, interest rates, you'll see them moving up when the economy, the economic outlook is expected to improve. And that would benefit some of the transportation stocks. And I'll talk about those in a little bit. But right now, I would say that we got a nice uptrend in play. You can see now that the PPO, the daily PPO, has been above the center line since back in the second week of August. And that honestly compares quite favorably to what we saw back earlier in 2020 when we were mostly below that center line. So really good action, I think. And I believe this is going to lead to additional strength as we close out 2020 and head into 2021. All right, talking technically, first thing I want to do here is I want to talk a little bit about the Dow. And I think we're still in the early stages of what I believe is going to be many more years of strength in US equities. We will have pullbacks along the way. We'll probably even have a couple more, maybe even a few more cyclical bear markets where you lose 20% in a fairly short period of time. You can kind of look back to the trade war issues that we had in the fourth quarter of 2018. That was about a 20% drop. Those are the types of things I'm talking about. But I believe the overriding trend for the next several years is going to be to the upside. And I like what's going on here on this weekly chart. You can see we've moved through the 20-week moving average back in May, early June, moved a little bit below it in June, and then rallied back to a new high, came back down 1 week, closed below the 20-day, the 20-week moving average, and then went right back up above it. You can see us now breaking out. Look at that weekly PPO. I mean, it's strengthening. Very, very strong action. So I see the momentum here being very strong. I'm on record. I would not be surprised to see the Dow hit 32,000 before this year ends. That would be another 6% or so. I wouldn't be surprised. I'm not saying we definitely get there, but normally when you make a big breakout above a milestone like this, you can look for some additional milestones to be taken out fairly soon. So I'm thinking we're going to get to 31,000, maybe even 32,000. We'll see by the end of the year. All right, so if the industrials are going to continue to move higher, I think one area that we really want to continue to focus on is the industrials. And when I look at the industrials, and I've on this chart here, you can see this is the relative chart. So the XLI versus the S&P 500. This is the absolute chart down here. Now, what I like about this chart is that we just saw an absolute breakout in October and into early November. I mean, this breakout right here took out that earlier high in 2020. So we're just getting that breakout. If you go back and you look at some of the bigger moves that have been made in the stock market, if we go back all the way to say 2013, remember we had a really strong 2013, 2014. Well, industrials here on a relative basis moved up after we got an absolute breakout. You see this sideways consolidation. Late 2012 into 2013, we made a breakout on an absolute basis. That led to outperformance in industrials. If we then fast forward to 2016, when we went sideways for about 2 years or a year and a half, when we finally made that absolute breakout, then we had the relative breakout, and industrials once again led during a very strong period of the market. 2016 throughout 2017 was very strong. I'm seeing the same thing repeat again here. Now, this was a much steeper drop. Obviously, a 100-year pandemic doesn't come along very often. But I treat this as though we had a high earlier in the year. We sideways consolidated. Well, we went down. But we didn't make the breakout until just recently. And now as we're making this breakout, look at how industrials on a relative basis are performing. I believe we're going to make another push back up on industrials to challenge that high back in 2018 in terms of relative action. Now, it might take a couple years. We might not get all the way back up there in 2021, but I do believe we're going to trend higher. I think industrials will lead the rally in 2021. All right, within the industrials, one more thing I'd like to look at, and that is the transports. So this is an interesting chart here. So the top part of this chart is just transports, the absolute chart. So how transports have performed. Then I've got the S&P 500 down here. And down at the bottom, I've got the transports relative to the S&P 500. Now, when we made the breakout, we're talking about the industrials back in late 2012, early 2013. Well, that was the same time transports broke out. Had a little bit of a downtrend here. We broke out. And then look at the transports go. And when the transports went, so too went the S&P 500. And transports actually led that rally. Then you can look and see we went through a couple years consolidation downtrend, and then we finally broke out latter part of 2016 in the transports and went higher all the way through the beginning of 2018. And you can see here that led to a very strong S&P 500. Now, in that case, we didn't really see any major relative strength. We did in the fourth quarter of 2016, but 2017 was kind of choppy. But this is relative strength. You can see absolute strength continue to move higher. So my point here is I believe transports are going higher. I don't know that if transports lead or not. My guess is that they will. But I think they're going to go along for the ride either way. Because what we've now seen is a breakout in transportation stocks. Whoops, right up here. So after 2 years of sideways consolidation, then the pandemic, we've now rallied back up and we've taken out these highs. And we're at an all-time high for transports. Only one reason why we would see that kind of action, and that is that the overall market is anticipating to go higher and that we're expecting global economic strength. And I think that leads to higher prices in transports. And I believe that leads to a very vibrant US stock market. I think it's going to be a global bull market that we experience for the next several years. But I'm of the opinion that the US continues to outperform. Let me also move on here to a new segment that I want to get into, which is behind the charts. This is let me go ahead and pull up the energy chart here first. So I'm not a fan of energy going forward on a relative basis. I do think energy will do well. But I think some of the strength we're seeing right now is not necessarily going to last, at least the relative strength that we're seeing. We are very beaten down, so I wouldn't be surprised to see a little bit more leadership in the short term. But longer term, I'm still not a big fan of energy. And I want to kind of walk you through this process. So if you look at the top part of this chart, this is energy, the energy sector ETF, the XLE, divided by the S&P 500. And if you look since 2008, really almost a double top, 2011, but really since that last top in 2011, the entire group relative to the S&P 500 has been downtrending. Now on the next panel here, this is just the absolute price chart of energy. So it went up, pulled back 2008, 2009, went up through 2014, and then went back down. Now, note that 2012, 2013, 2014, when we had that huge push in the S&P 500 to the upside, energy went up. But on a relative basis, it wasn't a leader. It's still kind of sliding to the downside. We saw a little bit of leadership here in 2014. but then that quickly fell apart. Down here at the bottom is the dollar chart. Now this is a 20-year weekly chart. And when you look back at energy, the movement, not only on their absolute chart, but also on the relative chart, energy tends to benefit from a weak dollar. So here, energy was outperforming the S&P 500, but we had a very weak dollar back then. Since this double bottom in 2011, which coincided with essentially this double top in the relative strength of energy, since that 2011 low, look at what the dollar's been doing. It's been moving higher. And as a result, energy has been underperforming throughout this entire process. Now, you might look at this and say, yeah, but the dollar is weakening now and energy is starting to bounce back up, seeing some relative strength. So is that going to continue? I don't believe it's going to, but before I tell you why, let me move over and show you the materials chart. Exact same chart, 20 years, relative strength of materials versus the S&P 500, materials on an absolute basis, and then the dollar index. Now, if you look at the absolute basis, you see that rally in 2005 to 2003 to 2008, little pullback during the financial crisis, and then movement all the way back up again. It looks like materials have just been doing wonderful, looking at the absolute chart. But when I move up here to the relative chart, you see a little bit of a difference. Materials have been underperforming since 2011, since that double top. And the common denominator here is that materials also face headwinds from a rising dollar. So here's the US dollar index from 2011 rising. And as it's rising, materials are going higher, but they're not outperforming. They're not leading the rally. And I think that's important because we want to try to outperform the S&P 500. And materials, it's very difficult to do that when you've got rising dollar. That just provides headwinds. So I want to go over the chart that I follow pretty closely, looking at my prospects or what I think is going to happen, most likely going to happen to the dollar in 2021. Now, when I used to, look at the dollar, and when I learned economics many years ago, a few decades ago, it was more about what was going on in the US. And so we just focused, is the US economy strengthening? If so, interest rates go up, the dollar strengthens, and that was kind of economics 101. Well, over the past few decades, we've become more of a global economic environment. We have more global issues to deal with. And so when I look at these various relative charts and ratios, the one that really stands out to me that has been a very good predictor on the dollar is when we compare what's going on with our interest rates here in the US versus interest rates in Germany. And I have just found through my studies that our market in the US tends to be pretty highly correlated to what goes on in Germany, both in our bond market and our stock market. And so when I started tracking this top part of this chart is the US 10-year Treasury yield minus the German 10-year Treasury yield. And so all we're doing is just looking at the difference between the two. And to me, it makes sense that if our interest rates are going up faster than Germany's, or if ours are going down less than Germany's, so if the difference between the two is rising, then it would make sense to me that our economy is being looked at as stronger than Germany's. Otherwise, the opposite would be happening and Germany's rates would be rising faster. So when you look at the two and you focus on this intermarket relationship here, what you see is that when this goes up, I mean, forget about the week-to-week movements, but just look at the charts themselves here. You go up, you come down, you go up, you come down. Here you go up, you come down, you go up, you come down. I mean, essentially, you've got the same type of movement, same directional flow between when we look at our rates here in the US versus Germany's on the 10-year treasury yield, and then what the dollar does. I think they tend to go hand in hand. And down here at the bottom, I have a correlation, which shows, are these two correlated? The difference between the yields in our two countries and the dollar. That's the correlation here. And what you see is that we spend most of our time in positive territory this goes back to 2006. Last 15 years, we have seen mostly positive correlation. So that when our rates are going up faster than Germany's, the dollar goes up. When our rates are going up less than Germany or going down faster than Germany, the dollar comes down. Now, these red circles down here are important because this is where we see negative correlation. So in other words, we're starting to move in opposite directions. It doesn't happen very often. So all of a sudden the dollar is veering and it's going in a different direction than what our treasury yields in the US and Germany would suggest that the dollar is going to do. So let me just point out a couple of these. I've got them highlighted. So the green shaded area is where we see the US yields going up faster than Germany's, but the dollar's going down. So that's going opposite. Okay, and so that green shaded area, this going up, this going down, leads to inverse correlation. Same thing with this one, where we saw the yield in the US relative to Germany going higher, but the dollar came down. And then this is the final one, where the yield in the US versus Germany is going up, dollar's going down. So all of those resulted in this inverse correlation that went down to the minus 0.5 level. And you can see over the last 15 years, this doesn't happen very often. In each of those three cases, look at what the dollar did afterwards. The dollar came roaring back. The dollar comes roaring back. The dollar comes roaring back. And then we go right back to positive correlation. So the dollar in those three instances played catch up. But that's not the only three instances. Here was an instance where the opposite happened, where we were seeing the US Treasury yield falling versus the German Treasury, 10-year Treasury yield. But while that was happening, we saw the dollar continuing to go higher. So that was opposite the others, because in this case, we're seeing US yields going down relative to Germany, but the dollar going up. But it still resulted in inverse correlation. So what happened? The dollar played catch up again. This time the dollar fell. So do you see how the dollar, when things tend to get out of whack, the dollar is the one that seems to be the catch-up mechanism to get things operating. And so we jump right back into positive territory. But now, look at what we're doing again. Now the dollar has continued moving lower the last several months. But look at what's going on in the US versus Germany in terms of the yield. We're moving back to the upside. So this would suggest to me that we should see a rising dollar, but right now we're not. Are we going to do what we've done pretty much over the last 15 years? Is the dollar going to play catch up? I think it's going to. And as the dollar gets closer and closer to this low from early 2018, notice that's also the tops over here. This is a pretty key area of support on the dollar. So as we make our way down, I know a lot of folks are writing the dollar off right now. I am not among those folks. I think the dollar could be setting up for a big move to the upside. The closer it gets to 88, 89, I'm going to say 89, the more I like it. The more I like the dollar move to the upside. And that gets me back to the XLE and the XLB, because if the dollar reverses and moves back to the upside, that's going to create headwinds for materials and energy. I don't expect them to lead the market if the dollar is rising. That's why I think those groups can go higher. I'm not saying that they're going to go down. I'm certainly not saying I would short them. I'm just saying if I'm looking for leadership, I don't know that I'd be looking at energy and materials based on what I see going on here between the yields in the US and Germany and what I expect that's going to, the impact that's going to have in the dollar in 2021. All right, let's take a quick look at just one or two earnings reports that came out after the bell. I've got to show you Stitch Fix. Stitch Fix, let me just grab one of these charts here. Let's pull it up. This is a stock that's actually on our short squeeze chart list. So this is a stock that's heavily shorted, okay? It's been trending higher. And when you look at it relative to its peers in the clothing and accessories area, at the end of October, it was at a 52-week high. Now, we've been pulling back, but we've mostly been pulling back as we do a lot of consolidation. We went back, tested that 50-day. They just came out with great numbers. They reported a profit of 9 cents. The market was expecting a loss of 17 cents. The stock's up 33% after hours. The shorts will be scrambling in the morning. I think it's really important to at least have the knowledge of what is being heavily shorted, because I would not be betting against the stock that's heavily shorted, especially when they're coming out with an earnings report. This is going to be a big day tomorrow, at least at the open, for Stitch Fix. Another company that came out with really good numbers, or at least the market is rewarding them, is Smartsheet, SMAR. This is in the software space. Now, Smartsheet, you can see, was making this breakout above the tops here, going into its earnings report. Volume was picking up. AD line's okay, not bad. I mean, it's down quite a bit from where it was in June, but it's been trending higher. On a relative basis, the stock has moved up to about a 6-7 month relative high versus software. So it was starting to show some pretty good strength. They reported a loss of 12 cents. Market was expecting 22 cents. Smartsheet's up 17.75% after hours. So looks like going to get a pretty good start to the day in the Smartsheet on Tuesday. All right, let's wrap this thing up with the 3 you must see. I'm going to give you 3 stocks that just are not performing very well relative to their peers. And one of them had been a favorite of mine for a while, and that was Microsoft. So if we take a look at Microsoft, you look at their chart, you don't really think anything negative here. I mean, it is consolidating. That's not bad. AD line doesn't look too bad. But look at Microsoft relative to its 52 or relative to its peers on a 52-week basis. It's at a 52-week low. It is literally at a 52-week low. Now, I talk about weakening relative strength when you're sideways consolidating, but I'm not talking about going to a 52-week relative low. I think Microsoft got some issues here. Maybe it just needs time to consolidate, but right now, I'm not a fan. I would stay away. I think there are a lot of software stocks that look better than Microsoft here. Next up, 3M. It's another one. Look at 3M. It's starting to move higher highs, higher lows, trending up. Doesn't look too bad. AD line's not very good, though. It's been drifting lower. But this is just part of the story. This is the absolute chart. We got to look at the relative chart. You want to see how 3M's doing versus its peers? Look at this. It's falling off a table relative to its peers. So you don't want to be in a stock if it's not a leader. And 3M is definitely not a leader. So when I looked at the chart, I thought, well, this isn't too bad, sitting on its 20-day moving average. I took one look at that relative strength, thought, no way, don't want to be a part of it. Last stock for today, Amgen. So this is in the biotech space. Remember, this has been one of those big companies, that's done well for a long period of time. Well, not really performing very well. Look at it relative to its biotech peers, 52-week relative low, trading below its moving averages, the 20s below the 50, the AD line's dropping. I don't like what I'm seeing here. I'd stay away from Amgen for now. All right, that is it for me for today. Appreciate everybody tuning in. I wish everybody a great Tuesday. I'll be back for your next Trading Places Live on Wednesday morning over at earningsbeats.com. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.